Welcome to episode 81 of Live with the Maverick. My name is Dominic Lee, founder of Maverick Actuary. We are a content community. Our mission is to maximize the impact and value of quant professionals on a global scale. The goal of this series is to educate our community on the most relevant themes in actuarial science, risk management, and analytics. The theme of today's discussion is legacy risks. And we are very excited to have with us our guest for today's episode, Gabriel Ware. Gabriel is a transaction actuary and consultant with a breadth of experience across major lines of business and markets in both company environments and Lloyd's. Welcome, Gabriel.
Thank you, Dominic. It's great to be here.
Great. Well, before we get started, I just want to give everyone a bit of an inside story on how we first connected. It was a couple of years ago, and I remember the Rams were playing in the Super Bowl, and Eminem and Dr. Dre and 50 Cent were performing. And 50 Cent did his iconic in the club performance where he came up on the bar, on the reverse bar. And I did this post on LinkedIn asking, what kind of coverage would that be? Like, because he was kind of doing this reverse crunch move. And I posted about it. And then, Gabriel commented and told me that he had been in entertainment. And I forget, it was like a special type of liability, Gabriel. I can't remember
Yeah,
exactly what it was. But
yeah, no, I remember responding that it would have been a part of live risks insurance or event insurance as they call it, and that was a major line of business at one of the companies at which I used to work and manage the reserves for them. So it was a fun a fun introduction. I had forgotten that was several years ago before we started talking about the current session.
yeah, and I was just like, yeah, I got to connect to this guy, and it's always good to meet actuaries who are doing interesting stuff. So yeah,
Yeah.
just love to give you an opportunity to introduce yourself.
Yeah, I guess that's a reminder that insurance is always involved and there's always coverage, for all sorts of antics, right?
Yeah.
Yes, but onto the equally exciting world of legacy risks, which of course has similar celebrities involved in such things, I imagine, right?
Yes.
Yes, good. Thank you, Dominic. It's good to be here. Background on me. My current role is, as you said, as a transaction actuary and as a consultant for my own company. Transactions, by their very nature, are project based, and so the opportunities available for me to have a consulting or contracting, or in the U.S. you might even say freelance, relationship with the various parties in the deal. Um, I enter this opportunity after recently concluding an internal full-time role in London as a transaction actuary for one of the premier legacy acquirers in the industry. It was one of the few truly full-time M&A roles in the industry. And over the course of my time there, I estimated I've considered over 250 potential acquisition targets. And that experience spanned most major markets, most exposures, most sizes of business, most transaction structures. So real breadth of experience in the M&A legacy risk space. Prior to that, my experience was in more traditional reserving roles. So I started as a consultant in New York, where my focus was mostly on U.S. risks for opinion work and other reserving contexts. I then moved to Europe, to the headquarters of a large global insurance group, where I was handling expert reserving work at headquarters for a variety of local and specialty portfolios, really all over the world. Then immediately prior to the transaction work, I was back in New York managing a reserving team for a carrier focused on large global corporate and specialty risks, including the entertainment line where the live risk experience sort of came in. So it was it was a portfolio focused on large risks, large corporate risks, where things can really go wrong, so to speak. So the key parts of my background that I use most as a transaction actuary would, number one, be a very strong technical expertise of reserving techniques. Transaction work is a place where it's important to be able to assess a potential portfolio correctly. to diagnose your own selections for bias, either high or low, and of course to assess potential areas of risk. That's the key need from a transaction actuary. I'd say it's helped me a lot to have a background managing a reserving portfolio, as that is the context in which estimates of a potential transaction are often presented. So it's helpful to understand, a reserving process, what reserving actuaries are up against, the various pressures, the context in which reserves are presented. But maybe most of all, it's important to have seen a widest possible variety of portfolios, as you've said before, particularly in longer-tailed exposures, but really from any sort of time period, from any sort of jurisdiction, from any sort of exposure. That's what you see most often as a transaction actuary. It's important for a transaction actuary to be able to really bring the absolute most diverse set of tools available to apply to really the most broad set of circumstances, in an environment where those estimates are really under extraordinarily high stakes in an M&A environment. So that's my background.
Yeah, interesting. So one thing I noticed, and it's funny because last episode we had on Simon, and he's from the UK, and then now he's in New York, and you did the opposite.
I
You kind
did,
of had some origins in New York, and then you went to London.
yeah,
So was it
yeah, and
mainly, would it be fair to say it was mainly for the opportunity that you made that leap?
I did. Legacy transaction work tends to be headquartered in either the London market or in Bermuda. And like Simon, in my history, you see a very global career in the insurance space and as an actuary, and I think that's extraordinarily helpful and enriching for a life to be lived in many different countries, like yourself as well, Dominic. So I think that's a really crucial part of a career for any actuary, transaction actuaries included.
Yeah, sounds like a great opportunity. So I did
Yeah.
mention that the theme of today's discussion is legacy risks. So for those of us who may not be familiar with the term, how would you describe a legacy? Like, what is a legacy risk?
Sure, sure. So I would paint a legacy risk sort of as one end of a continuum, with sort of ongoing risks at the other end. And in my mind, I usually say, I would usually define that as how much strategic value does that portfolio still have in the ongoing operations of an insurance company. So a pure legacy risk, would have very low strategic value going forward. And I'll give some examples. Before we go there, it's worth thinking about the size, and it's worth noting that PwC conducts a survey every year to measure the size of the legacy risk market, the P&C or non-life runoff market survey, as they call it every year. And that's really what they consider to be legacy risks that could be subject to a transaction. The most recent estimates were last year, and they estimated $960 billion globally, with about 60% in the US, 30% in the UK and Europe, and then 10% elsewhere. PwC will be releasing their 2024 estimates next week, actually, so I'm sure the community would be excited to check that out. But it's a huge market. And so there's huge opportunities for these sorts of deals to be done. So the best example that I have of really that 100% legacy risk, if you will, on that continuum, would be U.S. latent asbestos. So, most asbestos claims in the insurance industry are on general liability products policies from 1985 and prior. But because of the long latency of mesothelioma and because of the U.S. legal environment, the value of these liabilities can still be very large. But if you think about the time period of those policies, it's rare that the insurer is still writing the same insureds. So there aren't really many key relationships to brokers or to underwriters left regarding their asbestos book. it may be handled by a very dedicated claims staff, that's only handling that book. And so there may not be a lot of overlap with sort of their ongoing claims handling operations that would be focused on current customers. It's usually supported by a legacy claims system, which is often antiquated and can be very hard to maintain. So again, very little overlap to the ongoing operations. So again, strategically, it's sort of a distraction, right? Operationally, it's a distraction. Financially, it's either annoying because they have to strengthen reserves every now and then, or dangerous if they really have to strengthen reserves every now and then. And of course, financially, they also still have to hold capital to support those liabilities. So all those add up to something that it's a lot easier to sort of get rid of it than it is to sort of keep it around and keep paying the claims. And so those are usually prime targets for a legacy risk transaction. A little further down the continuum, another good example might be, whatever workplace injury is in the cards. So in the US, you would call it workers' compensation. Outside the US, you often call it employer's liability. Carriers who have been writing this business for a long time, have maintained a reasonably steady target appetite over time, but it will build a very, very large reserve portfolio that'll really take several decades to pay out. And so if the carrier decides to exit this line, it would generate a very large legacy reserve risk on the balance sheet. And the runoff is going to require a larger operational infrastructure, but again, it would have very limited value to the ongoing operations. These concepts aren't necessarily only portfolios that have placed into runoff. Some insurance companies will change their strategic direction often. You can see this more often in sort of D&O, E&O lines, or in professional indemnity lines, as it's called outside the US, where they may be a lot more agile or opportunistic, as they may call it, getting in and out of markets or in and out of lines as the over the course of their history. And this can generate pockets of legacy risk for the insurer that would have very little strategic value going forward. So these are often the prime places where they will then consider some sort of transaction on a legacy risk, to try and basically relieve themselves of some of that operational burden and from some of that distraction.
Good. So other than, you mentioned liability for asbestos or 85 and prior, and you mentioned workers' comp. Other than those two, are there any lines of business that are common for legacy risks?
Yeah, absolutely. So, I will say that most legacy transactions tend to deal with longer tail lines of business, and that is because the benefits to a primary company or to a carrier of getting that longer tailed risk off their balance sheet is quite a bit higher than if they were to try and seed off, say, a property portfolio that would pay out only in a few years. So usually it's general liability or public liability sort of things. Again, workers' compensation is a very important one. Professional indemnity, particularly if something has gone wrong or if the cycle has changed. Professional indemnity, where claims take a long time to pay out and they can be very, very risky. That tends to be a line that you see very often. And perhaps even more important is, we talked a bit about what it looks like on the primary side, but a reinsurer will usually have even the longer tailed claims, or they'll have the excess layers, or they'll have the areas where it'll take even longer to pay out. It can be more uncertain, and so reinsurers, especially who have very large reinsurance portfolios, can be prime targets for legacy acquisitions. The last thing we see is something I affectionately call sort of the gosh darn it situation. You see, all too often this happens in our industry, where a carrier decides to be very aggressive about entering a new market, and this can be any number of different things. They maybe even have entered that by poaching an existing underwriting team. from a competitor. They will grow quite strong in the first few years as they enter that line and they gain market share. And after a little while, they have the gosh darn it moment, or probably in language quite a bit more colorful than I'm going to expose your community to, the moment where they realize that underlying portfolio may not quite be as healthy as they had initially thought, right? And then they will try and pull out of that line as quickly as possible and perhaps consider a legacy transaction as part of putting that behind them. So sometimes you're getting portfolios that, the carrier might have stopped writing yesterday or a few weeks ago, or even are going to stop writing in the near future. And they're already coming to the legacy market to try and find a deal to put it behind them. And those are certainly some of the most challenging areas for an internal reserving actuary to handle in terms of the valuation, let alone the legacy transaction actuary that's trying to basically come at it fresh and think about a deal. So those can be other interesting areas to tackle as a transaction actuary.
Great. I like the analogy that you used of the continuum. So you talked about, okay, ongoing risks that have strategic value for the company. And then on the other
Mhm.
end, you talk about legacy risks. So I think, and you might have partially answered this when we think of how a risk goes from at one point being ongoing all the way to the end of the spectrum to be a legacy risk. You talked about a couple of things. You mentioned, potentially the the underwriter who was bringing in the portfolio, maybe those relationships are not there anymore. You mentioned that they got into this line of business and it's not as healthy as they thought it would be. Maybe there are changes in strategic direction. Are there any other reasons why a risk would go from transition from being an ongoing risk to a legacy risk?
Yeah, so there's a lot of reason, I mean, you talk about a change in strategic direction for the carrier, and there's a huge number of reasons why that can happen. A change in management, other M&A activity where a different carrier is acquiring a portfolio. Oftentimes, the back book of an acquisition won't necessarily be part of why a company wants to buy a new company. What they're really counting on is the ongoing operations or the infrastructure, et cetera. So, as things move around the insurance industry or as teams move around, often it will result in pockets of risk, if not entire books of business or entire companies, even, but, being placed into runoff or being then considered a legacy risk, and those can be part of a potential acquisition.
And a couple of things I know in our previous conversation you mentioned, which I think are important to mention important to note is underpricing. One is, I think when you said it was underpricing, so the insurer, I think, realized in hindsight that it was underpriced. And you talked about
Yeah.
portfolios taking, distressed portfolios that have taken a lot of reserve hits. So I think
Yes.
those are
Yeah,
good ones too.
those are very common reasons. And I guess, one thing from a transaction standpoint is, particularly as a portfolio ages, the original underpricing or the original growth or the original reasons for not wanting to be there may not make it an unattractive legacy acquisition, at that point. So, what makes something unattractive underwriting doesn't necessarily mean that the legacy market wouldn't be interested. It often just is a matter of how much it was underpriced and whether that's been fully accounted for now in the current valuation of the portfolio. That's usually you know that's usually the deal breaker, as opposed to the original flaws in however it may have been priced.
Okay. So you didn't mention that there's a sizable market for M&A, legacy transactions, and there's been a lot of M&A activity in the insurance industry in the past decade. And of course, legacy risks often results in legacy acquisition. So how would you describe a legacy acquisition?
Yeah, so we've hinted at a few different types of these over the conversation, but let's dig into the weeds on this a little bit. So a legacy acquisition would be where the seller of a liability portfolio, and here think about, an insurance carrier that has written workers' compensation for forever and now has a substantial back book, basically. So, but keep in mind that those are the ones selling the liability portfolio. And so they've decided to sell that liability or offload that liability to a buyer. And in the buyer's case, let's consider these as runoff specialists or as legacy carriers, or you know that. So that's usually where these transactions will originate. And there's several firms, several insurance companies out in the market who specialize in this sort of work. So the buyer of the legacy would usually write an insurance contract, so they are insurance companies, such that they would assume to pay for all of the liabilities, for all of the claims that are in that portfolio as it comes due. The insurance contract that they write, the seller would have some similar terms that an ongoing risk underwriter would recognize. It would have certainly a premium for that policy, which we can maybe think of as, from the seller's standpoint, hopefully equal to the valuation of the reserves, but we'll get into more of that later. That policy will usually have a policy limit. It'll usually have terms and conditions. It'll usually have exclusions. These are very bespoke, complex contracts, but most of the fundamentals of it are reasonably similar to an ongoing operation. And so, broadly speaking, there's always exceptions, but I would say these contracts sort of come in two major flavors, if you will. The most traditional one we would call a loss portfolio transfer, or an LPT. And then, the other one then maybe worth talking about is called an adverse development cover, or an ADC. And the key difference between these is really how much operational control is the seller really giving up. That's traditionally the way we think about it. So in a loss portfolio, really think about it as the seller is getting rid of everything. It's a fully clean break from them having to handle the legacy portfolio. The buyer of the portfolio will usually acquire all of the liabilities, really from ground up. They will usually acquire the responsibility to handle all of the claims. They will usually acquire the premium in the form of all the assets, and then they will get a chance to invest those assets as they see fit. And the seller of the portfolio will be rid of the underlying liabilities. They'll be rid of all the operational expense, whether it's people or whether it's operational systems that are involved in handling the claims. And then also, depending on the capital regime, they would get to release the capital that is supporting the reserve risk capital, at least, that is supporting those liabilities. So it's really a clean break, almost as if they never had that legacy risk there as well. An ADC is usually different. It's not that clean break from the standpoint of a carrier. It's usually the case where the legacy carrier will really only take the risk of adverse development, or the risk of reserves deteriorating on that legacy book. So the seller sort of has peace of mind that the future P&L would not be impacted by reserve development, but they would usually still be handling the claims. They would still have the majority of the assets in the reserves. They would still, some carriers would be a lot more comfortable with that because they would still be handling the claims. They would still be maintaining any customer relationships that were part of that portfolio, but they would still have all the costs associated with that in terms of both claims handlers, the operational expenses, the systems, etc. So that there's a lot of different varieties of those two major themes, and there can even be significant overlap between them. Not every LPT results in claims handlings transfer, for example. Not everyone results in all the assets transferring, but those are some of the major benefits to each party as they sort of as they think about these sorts of deals.
Quick follow-up on that regarding the capital. You talk about the benefit of capital relief for the seller.
Yes.
So is that more
Yeah.
just, I'm just thinking of it, I don't want to get too deep in the weed on
No.
accounting, but is it more just releasing reserves, or is it something separate, like from a regulatory capital perspective? How does that work?
It's in releasing reserves. So in Bermuda, for example, that's a lot easier one than thinking about the U.S. But per dollar of reserves, usually an insurance company is holding about 33 cents of capital in the reserve risk of that. So if they are able to move, say, 100 million of reserves off of their balance sheet and give it to a legacy acquirer, their capital requirement under Bermuda solvency would actually decrease by about 33 million, which really can improve all their metrics like return on capital, like IRRs, and all those sorts of things, can be greatly improved by being more capital efficient as an insurance company. And so that's the concept, and it's usually a very large benefit afforded a seller of these legacy risks.
Interesting. So you did mention that legacy acquisitions involve two parties, a buyer and the seller. And it's funny because
Yes,
in this case, the seller is actually paying money. So I thought that was interesting.
it is.
Now, so what are the key considerations for both parties regarding legacy transactions? So for the buyer and the seller?
Yeah, no, absolutely, and you're right. So if you're selling a liability, you will have to actually pay money to another party in order to assume that liability. So it's a little different than how one may think of as buying and selling in a more general non-insurance M&A context. But yeah, so when it comes to an actual deal, there are many considerations for each side, and usually they are subject to substantial negotiation and due diligence. Let's place again this a little bit in context. I mean, I mentioned earlier that that I had the opportunity to consider over 250 deals over the course of my time, but only around 15 of them actually secured. And I think we need to remember that as we place a lot of these in context. Only a very small percentage um, of legacy transactions that are brought to market are actually able to overcome all of the various hurdles in between that buyer and seller relationship. So I think that stat usually surprises people who don't live and breathe the legacy transactions each and every day. From the seller's standpoint, they're clearly looking for the most attractive price possible, and ultimately, it's a situation where they're trying to get rid of something. So usually, there's not a lot of incentive for them to overpay. There's not a lot of incentive for them to take a profit loss on it. And indeed, the seller will often try and do a deal at what they call P&L neutral, which is where the amount of premium that they're paying is equal to their valuation of the liabilities that are being removed from their balance sheet. In essence, that's usually what a goal that the seller will have as part of that transaction. And clearly, that dynamic can be quite challenging if the legacy carrier and the transaction actuaries that work for the legacy carrier believe that the seller's view of those reserves is too optimistic, and that far and away is the biggest reason why transactions fail to close. And then that difference of opinion on really where the on the valuation of the liabilities. Um, and for most sellers, a legacy deal is one option of several that are available to them. I mean, usually they can always hold on to the risk and just run it off themselves. So they can be pretty price sensitive, just like most other insurance contexts. And so usually they're not necessarily forced, if you will, to do a deal. But like any other insurance contract, there are lots of other items to consider for the seller. The seller may place additional value on the strength and the reputation of the legacy carrier, just like any other insurance contract. These transactions are significant enough that they often require regulatory approval to close. And a weak legacy carrier may struggle to convince a regulator that they can actually handle the risk. Even worse, a weak legacy carrier may struggle to fully pay off the liabilities. And we are actually seeing several legacy carriers now in the market run into trouble as a result of prior mispricing and mismanagement of certain transactions that have caused them trouble. So those considerations are very important for a seller of these liabilities as well. In terms of the reputation of the legacy carrier, we mentioned that claims handling may transfer, but ultimately the seller of the liabilities would still be would still be on risk if the buyer was mismanaging the claims handling. If they weren't treating policyholders fairly, they wouldn't go to the legacy carrier for their complaints. They would go to the original seller. And so if the seller really wants a clean break, they need to make sure that the reputation of the legacy carrier is strong enough to be able to really make sure the portfolio is gone. For the legacy carrier, generally speaking, more control of the assets and the liabilities generally means they can offer a more attractive price. They usually want to be in control of their own destiny in terms of how that portfolio is going to run off. And by far the most significant is claims control. A portfolio of claims to a legacy carrier is as significant, or sometimes even more significant, as a portfolio of assets would be to a good asset manager. The claims staff of a legacy carrier is highly skilled at settling claims in the most cost-effective manner, usually being able to beat what an ongoing carrier would do by even 10% or more, depending on the line of business, because they really treat that legacy portfolio as their asset. And in a competitive transaction, a lot of these savings will be passed on to the seller of these liabilities in the form of a lower premium for the risk, because the legacy carrier would be able to incorporate their claims efficiencies into a lower and more competitive price.
Interesting. So you actually had given me a really good example before. I think you talked about like if there was an undiscounted amount of like 100 million, they may pay like 90 million for it to the buyer.
Yes. It's a legacy carrier won't always be able to promise being able to come in at the valuation or below the valuation, et cetera. But if the legacy carrier and the seller of those liabilities do agree on the liabilities, do both believe that the valuation of the liabilities is very close, which obviously, as we discussed before, can be a very big if. Then if you look at what the legacy carrier is able to do with the claims in order, from a claims handling standpoint, that they believe they would be able to settle it below those, that they would also be able to have the assets and to be able to make, usually they can invest them at a bit of a higher rate of return than an ongoing carrier, because they aren't necessarily subject to liquidity shocks like cat risk, et cetera. Then the legacy carrier will, if they really want the portfolio, will endeavor to try and give them a price for that portfolio that is P&L neutral or even better. Now, if the carrier is under reserved by 10%, 15%, believe me, I've seen well higher than that. Then obviously that would be very unlikely to happen without substantial other restructuring for the legacy carrier to try and de-risk that book.
The question I was going to ask is, what seems interesting is that the seller thinks this stuff is bad, but the buyer obviously thinks it's good. But it sounds like the benefit to them is more, like you said, it's an asset to them, and then they can invest it. They don't have some of those, like you said, liquidity shocks. So for that perspective, they're getting money.
Yes. And the legacy market is good at helping sellers take care of problems, right? I mean, the transactions we're talking about, that there's a reason that it's no longer a strategic importance to the ongoing carrier. There's usually a reason they want to get rid of it, because if they do a deal like this and they actually move it off their balance sheet, what they have is certainty about the future reserve development of that portfolio. There will be none that will hit their portfolio, and that's a really big peace of mind that a legacy carrier is able to afford. The seller of these sorts of risks. If you think about it with asbestos, for example, usually a carrier who has the asbestos liabilities again, it's sort of obnoxious that, every so often they need to strengthen the reserves, strengthen reserves, and strengthen the reserves. It's very annoying for them, even if they're not strengthening to an area where it's dangerous for them from a solvency standpoint. And so usually they just want to say, I want it off. I want it done, And so they, like any other insurance, they pay someone to offload the risk.
Yeah. No, yeah, we talked about the fact that many of these don't close. So
Yeah,
of course, when they do, they're like, I think of the concept of an ambivalence point. So they have to get to a point where, let's just say they come to the table and there's differences in opinion.
there is.
How do they, yeah, so how do they arrive at this ambivalence point or agreement point when there are
Yeah,
differences in opinion?
yeah. So, um, you know, so the contracts are subject to a lot of negotiation. That there's no question on that. So, there if there's usually a price that the legacy market will offer for what might be considered the most vanilla transaction, like a pure LPT, claims handling transfer, assets transfer, all the things that the legacy market would want. Um, there's usually a price for that, and if the legacy market believes the the reserves are undervalued, then that price might be higher than the seller of the liabilities would be willing to pay in order to offload the risk. And then usually there can be some negotiation. So, for example, if the legacy carrier is looking at, uh, 300 million of liabilities, but there's one particular line of business that they really believe that the seller has undervalued, right? That there's one line of business that is under reserved. Well, if the seller really believes their answer and the legacy carrier really believes the higher answer, then maybe there's potential to put a supplement on that to where the legacy carrier will only cover those claims up to a certain amount, and then the claims would go back to the seller, really. And so the difference there is that in that case the seller doesn't necessarily get a clean break because they are still on risk for a particular line of business that if the claims deteriorate a certain amount. But at the same time, if you're taking away some of the risk to the legacy carrier, usually the price can start to come down. And so these are the sort of structuring things that maybe that can be part of the negotiation that may help them come closer to a transaction that works for all parties.
Yeah, I imagine that there could be widely disparate viewpoints on some of these lines of business. When you think of some of these high variability lines like excess casualty,
Yes.
umbrella, I could see
Yes.
how that
Yeah,
could
yeah,
be.
and even on asbestos, and the thing about one of the pleasures of the transaction actuary role is that if you've seen over 250 portfolios, I won't say you've seen everything, but you've seen most of it, and you have tended to see more variety of the various risks that are coming across your desk than even the internal reserving actuary has seen. So they've seen their portfolio and they may have a certain view on their portfolio, but if you've seen 20 of those, you can place that portfolio in a lot broader context that can help you be a lot more informed about where you believe those risks should be going. And so I think that's really one of the strengths of the transaction actuary and why that experience is so valuable.
Great. So speaking of the transaction actuary, how would you describe the role of a transaction actuary, and how does that differ from that of a traditional actuary?
Yeah, no, there's no question, and I certainly am, and I certainly very much identify with the job title of a transaction actuary, and I see those as very different from some of the other roles in the industry, and I'm very happy to be one. And so while some of the techniques that a transaction actuary uses would be recognized, particularly by a reserving actuary, because usually we are pricing legacy portfolios, and so we're looking at a portfolio of reserves or a portfolio of liabilities.
And
I
really
think
quickly,
therefore,
sorry, you're sorry,
yeah,
really quickly. You are working on the as a transaction actuary, you're working on the buy side, right, for the legacy carrier. Would that be fair?
that's usually been where my experience is, but transaction actuaries can absolutely work on the sell side. You're participating in an M&A process. And so, there's an opportunity for transaction actuaries, if you are a very, if you're a party that is bringing a lot of portfolios to market, then you should have transaction actuaries who are familiar with how an M&A transaction works. And then there's also, I would even say that some of the things that intermediaries do. So in this space, there are usually reasonably specialized brokers that are involved in the legacy space, and they will have actuaries on staff that are familiar with the M&A process, that understand how it works. And so a lot of them as well, I would say that they have components of being a transaction actuary, in terms of, familiar with how transactions work, as opposed to necessarily managing a portfolio of reserves or pricing individual contracts. Yeah. So from a transaction actuary standpoint, I would say that there are still very significant differences in both the analysis that they do and really the context of their results. When I think about my priorities as a reserving actuary, when I managed a reserve portfolio, I was looking first and foremost to protect the balance sheet of the company, right? You must ensure that reserves are adequate, that they're reasonable, that they'll protect policyholders, that they'll protect your company, and therefore you usually want a built-in level of conservatism in those reserves, and some reserving actuaries may bristle at some of that, but I certainly, that was my goal when I was a reserving actuary and managing a reserve portfolio. Reserves are usually part of an extensive governance process, between regulators and auditors. They really must be transparent. They have to be compliant. They have to be auditable. And therefore, it can be a great benefit to a reserving actuary if they're using a relatively standard set of techniques in a stable and a governed environment. This also is a very big benefit to a reserving actuary, because as a result of that stable process that they have to set reserves, reserving actuaries have a real strength at noticing when things change over time and new trends coming through the numbers and new trends in the portfolio. And they can use that feedback loop to improve their assumptions and drive communication to the business. Transaction actuaries look at a portfolio once. There's no change in assumptions over time. And they usually look at that portfolio once under very tight transaction M&A deadlines, and with quite limited information as compared to, the discussions that a reserving actuary may have. There's no stable process in a transaction environment. And as they're used for pricing very large deals, transaction estimates cannot be aggressive. They cannot be conservative. My mentor in the transaction actuary space said, on day one as a transaction actuary, we knock the margin out of your estimates, and I always pictured, this caning, say, you're not going to be conservative anymore. So, a transaction actually really needs to be comfortable that stakeholders are going to make very significant decisions based on your first crack at a very detailed analysis, and but something you have to arrive at very, very quickly. And your stakeholders are basically going to decide based on that analysis to go long or short, to use the investment terminology, on a particular portfolio based on your estimate. And it requires a level of decisiveness and execution that, quite frankly, would have scared me, as in my role as a reserving actuary. So in lieu of that transparent, stable, auditable process, a transaction actuary is strongest when they have the broadest possible set of tools and experiences available, so that they can flexibly, quickly, and agilely, move to really the most appropriate tool for the specific and highly customized situation that they may face. So it's a very different mentality that you tackle, when you're doing this in an M&A context.
That's interesting. I mean, it sounds exciting. There's a different environment, it's different considerations. Like you said, you get one
Yeah.
shot versus being able to do a reserve quarterly, a review quarterly several different times.
It is. I mean, that part of a transaction, actually, you just feel the rush, every day. And of course, you have to keep your cool head in order to make sure that your analysis is correct and spot on, and that you really are right. But it's a rush that you don't get, that I never got, certainly as part of a reserving actuary role.
Yeah. So you mentioned earlier that you've worked on, I think, up to 250 transactions. You've seen quite a bit. So I imagine that you have some interesting war stories. So
Oh
are
yeah.
there any specific examples of, anything that you're comfortable sharing of market transactions that you've observed and been a
Um,
part of in practice?
my goodness, you see some things in this sort of business. That is, when you're in the business of trying to acquire legacy risks, legacy risks can take on a lot of different flavors with a lot of different characters. Managing those risks over the course of this lovely industry of which we are a part. Yeah. So some of the more interesting and higher stakes transactions, actually, that I've been involved in, are in support of actually broader M&A deals. So when one insurance company decides to buy another for the ongoing business, sort of as we mentioned earlier, they're usually placing more value on the current portfolio, the current teams, the current operations, the current distributions of that target company, but they're usually not interested in taking on the back book, taking on the risk of reserve development, or taking on the risk of a significant valuation to that underlying company as a result of reserve deterioration. And so ongoing M&A deals can often be coupled with a legacy transaction in order to de-risk the target, either by the target shareholders who want to de-risk before selling because they'll hope that they can get sort of a higher valuation for the company, or the acquirer, may want to execute a legacy deal shortly thereafter, and as part of the overall integrations of the company, to sort of leave some of that past behind them. They weren't familiar with necessarily the underwriting operations that took that over, and so they will usually just want to de-risk that. The most recent high profile example of something like this was the recent transaction where AIG sold Validus to RenRe. And as part of the deal, AIG did retain some of the reserve risk on Validus, as they were selling that to RenRe. And so, AIG was able to engage with a legacy carrier to sort of step in and provide AIG with basically some coverage on that reserve risks, so that from a market standpoint, AIG was able to communicate a much cleaner divestiture of Validus, in that transaction going to RenRe. So that's the sort of place where you're bringing in a few different M&A deals into one of which is a legacy transaction. So those can be particularly high stakes, and particularly exciting to work on as you're part of that, right? um I think you know I think if you speak to a lot of transaction actuaries, they'll probably remember like the largest deals or the most money involved or the most complicated. But for me, what I've looked back on most on in terms of war stories is the ones where my analysis drove key negotiating areas of the deal that made the deal significantly better, for my stakeholders and for my shareholders at the time. And I think a transaction environment really affords the actuary the opportunity to beat the market. And particularly, one familiar with reserving techniques, sometimes by taking a contrarian view of the portfolio, sometimes by finding key holes in the target's assumptions. And while usually this has resulted in the opposing actuaries missing some key information where their estimate is too low, and usually that can, usually there would not necessarily be a deal there. But on occasion, this has actually resulted in their number being too high, or the broker missed a key piece of information, or the target maybe has the right overall reserve level, but they are too high in certain lines of business and too low in others. And as a transaction actuary, you're in an environment where those difference of views can really be exploited to one's advantage. So it can get very competitive. And you can, you're in a place where, you can sort of, see those holes and really turn them into very profitable deals. And as we've said before, there really is a deal fever, adrenaline rush that you get from that sort of situation that you just wouldn't be able to replicate in too many other environments.
So did you have
You
it
know,
ever have any aha moment where you're like, I can't believe this just happened?
oh, absolutely can't believe this just happened. So, I mean, I think some of, that there have been, portfolios in the press or companies in the press that have been under distress, that they've talked about the need for a legacy transaction, and, I think, the ones where you're just like, I can't believe this just happened, are ones where, you see a portfolio, it's usually quite under reserved. They usually trying to get it off their books. You can't reach a deal because they have more pain to go. So a year, they come back a year later, maybe even a different broker, maybe even a completely different context. But you look at it and you're like, oh, it's still the same book. And now they've taken a whole bunch of reserve hits where, the price they were offered a year ago, maybe they would be very anxious to get that price now, hopefully, where they really want that price now. But a year later with the reserve development, that price isn't necessarily on the table. But you feel pretty good as a transaction actuary because, as you might expect with, looking at 250 and securing 15, that there's a huge portion of this business that's making sure that your own company avoids mistakes, that doesn't write a portfolio that then deteriorates significantly. And there are plenty of places where we sort of get validation from that, either by a portfolio coming back to market and it's certainly shown certain amount of deterioration, or if a competitor takes the portfolio at a price that we thought was not correct, or that was too low, and then later on in the industry press you see that that legacy carrier has not necessarily been able to handle it, or that they've experienced pain as a result of writing that deal. And so you do get areas of validation, in what you're trying to do, and these situations can offer very valuable lessons, in trying to evaluate what you got wrong, what you got right, so that you can be more confident in when the next of these situations rolls around. So you see quite a bit like that as well.
Excellent. Well, this has been, quite an illuminating hour or so. I've learned quite a bit about legacy risks, and I'm looking forward to sharing this with the community. I know everyone will learn a lot too. So, Gabriel, just want to thank you so much for your time, and let's definitely keep in touch.
My pleasure, Dominic. I think these sessions are fantastic. I think you're doing the profession a real big service by having these sorts of interviews. And I'll also thank the members of the community who are taking their time to watch these sessions, mine and I've watched several of your other interviews around. I think they're really fantastic. So thank you to everyone, and to anyone who is watching this and has further questions, I'm on LinkedIn. You can find me through Dominic's page. More than happy to keep the conversation going. So thank you.
Thank you, Gabriel.